Hello, everyone. Welcome to the Lytham Partners Spring 2025 Investor Conference. My name is Ben Shamsian, Vice President at Lytham Partners. Before we begin with our presentation entitled Microcap Market, Data, Deals, and What's Next, for those not familiar with Lytham Partners, it is one of the country's leading investor relations firms. With more than 2 decades of corporate access experience, we have built one of the industry's most diverse and effective platforms for connecting small cap companies with high quality and focused institutional investors while creating a framework of best practices in all aspects of investor relations. Today's presentation is hopefully yet another example of where we bring some value to you and multiple constituents. And now for our keynote presentation, we welcome Joseph Lucosky of Lucosky Brookman and Michael Jacobs of the Benchmark Company. Mr. Lucosky is the founder and managing partner of Lucosky Brookman. He's a financial professional and a legal one. Joe's extremely passionate about strategically leading the rapid and efficient advancement of micro and small cap companies, taking them to new heights. Lucosky Brookman is a legal firm, industry leader in microcap IPOs and uplistings, domestic and foreign. And we're happy to have him. Michael Jacobs is the head of capital markets at the Benchmark Company. Michael is an investment banking capital markets veteran, having served the firms such as Axiom Capital, and Capital Growth Financial. Benchmark was founded in 1988, based in New York, with operations around the country, where they cover institutional clients and collaborate with research, sales and trading, and investment banking. So with that, gentlemen, welcome.
Thanks,
Thank
Ben. Great to
thank you,
have,
Ben.
great to be here.
Sure.
And Michael, always a pleasure to be with you. We seem to do wonderfully together on panels, and looking forward to today's discussion.
There's nothing better than doing it with you, Joe. And I share your passion and crusade for the microcap, nanocap markets.
All right. Well, thanks, everyone. Joe, I want to begin with you. I believe Lucosky Brookman is the only law firm in the country, probably in the world, that tracks all the uplists and cross-lists and IPOs in the microcap space. We look at that data very intensely, as well as does a lot of the participants in the industry. Can you tell us a bit more about your data-driven approach and the value it brings to your clients?
Sure. This is, to me, is the most important question we're going to talk about today, because as you said, we at Lucosky Brookman, myself, my partners, our team, are very passionate about the microcap world. And we noticed many years ago, probably in 2019 and into the pandemic of 2020, that finding microcap data on a consistent basis was really difficult, because a lot of the trackers and softwares and companies out there don't track deals below $50 million. And the exchanges don't prioritize the micro and nano cap markets. So a lot of these emerging growth companies, founders, entrepreneurs were being ignored as far as deal data was concerned. So in 2020, we looked around the market and said, you know what? Somebody has to start doing this. So instead of just doing what every other law firm does or every other professional does and giving their individual experience or what they think the market may say or may do, we started tracking every uplist, cross list, and microcap IPO consistently every month, looking at the data, curating the numbers, putting analysis together to make better decisions in the marketplace. And now, because of the new rules, which I know we're going to talk about later for NASDAQ, we're also starting to track direct listings, which have become very exciting over time. So just to give you a quick example, we could take data in the marketplace based on structures, based on dollars raised, based on trends that we see in the marketplace, and apply those to transactions in a very real-time basis. So our clients get better deals. The industry as a whole makes better decisions. And one other thing that's really important, we share this data. We give it away for free. We don't hoard it. We're not territorial about it. We really want the ecosystem to develop, get better, grow, become larger. And we share it with bankers like Michael, with founders, with CEOs, with everyone in the industry who will listen. And it really is valuable on the uplist, cross list, microcap IPO, and now direct listing side.
Okay. Joe, before we really dive into this data and into what the data looks like for 2025, can you walk us through the main trends from the past couple years in the microcap IPO market? Just the highlights, because at the end of it all, it's all connected. I mean, we really understand where we are now in 2025. We need to understand where we've come from.
Sure. Again, I love this too because again, we've been tracking data now for almost 6 years. And again, we can get into minutia of deals and the structures and a point by point analysis. But I think it's really important to understand where the market has come over the last 6 years, especially in the microcap. Forget about the broader markets. You can read that in the Wall Street Journal or look at CNBC. But again, nobody is covering the microcap world. So from our perspective, we use the IPO world as a barometer, or at least we have for the last 5 years. We'll see what 2025 brings. But starting back in 2020, as everyone knows, that was the year of COVID. The first 6 months of that year were a roller coaster. Nobody knew what was going to happen. Deals were dying. Some deals were getting done. Everybody was nervous. And then something happened in August of 2020 where it just became bananas and deals started to work. Confidence came back into the marketplace, and the end of 2020 was very robust, which brought us really into 2021, which we refer to as the hockey stick year. I mean, if almost any deal could get done in 2021, if you couldn't get a deal done in 2021, it was either an extremely bad deal or you didn't know what you were doing. So 2021 was one of the most robust years in recent memory. And, when I talk to people in the industry, people lament and want to go back to 2021. 2022, for the first 6 months, was really quite robust, just like 2021. It basically, we call it chugging along, capitalizing off the momentum of the hockey stick year of 2021. But then in the summer, early fall of 2022, something happened. NASDAQ took a pause. They paused all microcap IPO deals to reevaluate their approval criteria. So that really put a dent in the marketplace at the end of 2022. And of course, the market turned in 2023. And the theme of that year really was less dollars, less capital, less valuations. And we term that less is more. So 2023 was a year of transition where smaller deal sizes, more increased play on selling shareholders to get to that $15 million number for a microcap company to list. Less was more across the board. Bringing it into 2024 was really tracking 2023, where less was more is the theme, but with some regulatory changes. You may remember in September of 2024, the New York Stock Exchange changed their rules. They put new minimum capital requirements for microcap companies, minimum raise of $10 million, along with some other regulatory changes by NASDAQ. And that really brought us into 2025, which ended up being, or started out to being, a very robust first quarter. And then, of course, NASDAQ changed their rules, implemented a new $15 million minimum for most companies without net income. And right now, we are actually getting this data real time and tracking what that will look like and how that will play out in the market. So far, it's been still pretty robust, but I know we're going to talk a little bit later and dig into the details about how many deals, what size, and what they mean for the marketplace. So that's a fairly high-level summary of the last 6 years in the microcap world.
Joe, taking some of the high level and putting some specificity on it. Going back to 2020, there was a transaction I was working on, 1920, that took, I don't know, forever to get through the SEC. I wasn't in NASDAQ at that point, but only SEC issue. Late March, we got SEC clearance. I called CEO of Benchmark up and I said, my crazy client wants us to go in the market next week. And the CEO over the phone says, why don't you? I said, Rich, it's COVID. We don't know what's going on. We don't know where anybody is. We don't know anybody wants to buy anything. He said, what are you doing now? I said, well, I'm standing by my pool in Florida in a bathing suit. He said, point driven. You're going to launch that IPO, which got done. We raised $25 million for that company in 2020. And we probably did 3x what we would usually do in a year. So in a year that nothing was getting done, that was a great year.
It was certainly robust. That last 6 months of 2020 really became the precursor, the beginning of that hockey stick for 2021.
And I really wish less is more was more of a Miller Lite or Bud Light commercial, but certainly not. Joe, if you asked me 24, 36 months ago if I would ever contemplate doing a 5, 6, 7 million dollar IPO, I would have told you you were nuts. That in 35-year investment banking career, I had
Mhm.
never done an IPO that was sub, I don't know,
Mhm.
10 or 12, and that they didn't exist and they didn't make sense. Well, guess what? It would probably take most of the fingers on one hand to count the number of sub $10 million IPOs we've done in 2023, 2024. And even in 2024, Joe, you and I together did the best performing IPO on Wall Street for nanonuclear. It was a $12 million IPO. Now, granted, we raised $125 million for the company in the 6 months of late 2024 post the IPO, which is also unheard of. But even the initial size of that transaction was only 12 going in.
That's no, that's such an important point. And we're going to talk about nanonuclear. I reserved a little bit of a spot later in the process because it's such an important deal for a number of reasons. But you make a great point, Michael. This is why we track the data. Because when you say, hey, I could never imagine doing an IPO under $25 million or $20 million, that's what a lot of people think. When we go around the country and we speak to everybody in the microcap ecosystem, we give these keynote speeches at conferences, we talk to founders. They have the same sort of analysis that you do and thought process. And then we show them how the microcap data works. They're often very surprised. One of the things I heard
Go
in
forward, take us through the data because I don't believe your facts and I know they're true.
it is so true. In 2023, the number of deals wasn't so bad, but they were down, 6, 7, $8 million average deals. Let's move to to the next slide here. Ben, maybe we could talk about this a little bit and sort of how these IPOs have played out. And maybe Michael, you can talk to us about, the disappearance of the fundamental investor. We've talked about this many times and sort of how the market has changed and shifted from 2020 to 2024, where the deal sizes have become down, the reliance on selling shareholders has gone up, and now that has all been turned on its head with the new rules as of April 11th, 2025. But let's go back in time for a second and talk about where that fundamental investor has gone.
So I wish I could tell you where they went, but something happened with the boom in 2021 where everything was not only robust, but investors were just making a lot of money, particularly in the technology sector. And they just didn't come back from COVID. They distributed out of funds, they shut down, they converted to family offices from outside investors, and just demand for investing, particularly in IPOs. The follow on market is a total different animal that we're not even talking about today. But they just disappeared as a IPO supporter, which is very much the explanation of this slide where why the number of foreign private issuers went up so dramatically over several years, why the average deal size went down. Joe, look at this, 2021 to 2024, it's down by 3/4 or 2/3. It's went down from 25 to 7.
Yeah, and one of the things that nobody believes us when we show the data, but it's such an important point. Can you imagine in 2021 asking selling shareholders to be registered in a prospectus? Nobody wanted anything to do with selling shareholders in 2021. You couldn't get them. Nobody wanted them. Bankers didn't want them. Deals wouldn't support them. You couldn't find a selling shareholder in 2021. But as the market became less and the value's gone down and the average offering size has gone down, the importance of selling shareholders has gotten increased over time. So it's actually an inverted relationship. If you look at the median offering size, it's inverted to the IPO registering selling shareholders. And you say you can't imagine an IPO below 25 million. Well, here we are. And with the new rules as of April, it's going to get even more difficult, but trending upwards. So one other thing, Michael, that I think is important, and I really want your take on this, is the foreign private issuers. Because as you know, and I think as you know, most people who read our data, about 71% of the IPO market in 2024 was from foreign private issuers. But you really got to dig into the data to understand what that market is and why it's there. But maybe you could talk a little bit from your opinion. I know you've done foreign deals, we've done foreign deals. What is your thoughts on why the foreign market has become such an important part of this microcap world over the last year or two as the market has become more challenged?
So trying to stay away from politics and from regulation in a minute, which we'll get to. I mean, the facts and the truth is that as demand for participation in IPOs here has waned, you got to get the money from somewhere. Even if you're doing $7-10 million IPO without much institutional demand, you're not going to do all that from retail. And Wall Street, big and small, started looking at the companies themselves to bring a portion of the capital for an IPO, whether that's from existing investors, friends of the company, and the foreign private issuers just seem to have more demand for their own IPOs or more access to capital for friends and family to participate in the IPOs than domestically. Some of that's based on people's willingness or desire or need to get money out of some of these countries, like China, into securities in the US. Some of it comes to it's became very acceptable for foreign companies to have to bring the lion's share of the money. And I actually think I created that accidentally in 2013 or 14 when I tried to get an IPO done, or the first microcap IPO for a Chinese company done. I couldn't raise the money. I went to the company, said, guys, I can raise X. We need to get to Y. You need to bring the difference between X plus Y. And it happened and it worked. And over that 10-year period, just think foreign companies got more used to knowing that there's not a lot of capital for them here and to have to bring a good preponderance of an IPO.
Yeah. Well, that's I just spoke about this a few weeks ago when I was at NASDAQ for the IPO summit. There were a lot of questions about why foreign private issuers are such an important part, an important makeup of the microcap world. And there's really a couple reasons in my mind. One is that when the markets get challenged, generally these foreign companies have a little bit better balance sheets, might be a little bit bigger, maybe closer to cash flow positive, or maybe even have net income. So that's one aspect of it. The other aspect of it is exactly what you said, this concept of directed orders. I think this is something that's not talked about enough in the industry. So if you look at that 71% that makes up the microcap world coming from foreign private issuers, a lot of those deals, a majority of those deals are coming with what we call in the industry directed orders. Just like you said, the companies are bringing their friends, their family, their relationships from Asia or from other parts of the world and investing in these IPOs. So the bankers either have to raise no money in some cases, the most extreme cases, and less money in other cases. But I think it's really important for companies and founders and CEOs and others to look at the underlying data of these deals, because I think there's a lot of people running around saying, oh my gosh, look at these foreign companies, when in reality, they're not raising the money here in the US. They're coming with the money, they're directing the money. And just as an aside, the exchanges don't love these directed order approaches. And that's why, we struggle and beat our head against the wall a lot of times with this second deal qualification when you're pricing a deal and getting all the orders fulfilled and having NASDAQ approve them. Part of that is because of the directed order approach that you point out.
I think one of the reasons we don't talk about it a lot, Joe, is we're embarrassed by it. The fact that if you go back to 21, 22, you were able to do an IPO with an average of 25 million or 15 million. But then the demands really disappeared. And to get a deal done, we need to go down in size and rely more on the companies and their direct access to capital rather than access the capital that the banks can bring.
And we're going to talk about in a moment here, but as the companies have to raise more money to get listed under the new rules, that requirement, I suspect, is going to continue to go up, not just on the foreign side, but also on the domestic side. Because I'd love to get your thoughts, Michael, and we're going to talk right now about some of these new rules. But what is your view right now? And I'll just give you this data point because I don't want you to not have it. So there's been about 64 microcap IPOs year to date. That's pretty much halfway through the midpoint of May. We're going to talk about that on the future slide. But only 6 of them have been greater than $15 million. And as you know, the new rules, there's, some controversy over this $15 million capital raise. But what is your view right now of the market? Can companies really raise $15 million? And is $15 million the right number? Or is it 16, 17, 18 because of the overallotment green shoe requirement that most banks, will run with?
Give me that stat again, Joe. What were those 6 IPOs? Those were over
So out of
what
the
size?
64 microcap IPOs,
Right.
there were about 6 or 7 that raised $15 million plus. Every other single one of them either listed pre-April 11th in a combination of selling shareholders and primary capital under the old rules, and some of them raised less than $15 million because they met the net income standard. But there were only 6 or 7 that raised greater than $15 million.
So I've done 5. So when you and I go through the history of the microcaps, I'm usually good for 7.5 to 12.5% of the deals done on the street, depending on the year, the quarter, what have you. So I've done 4 IPOs and 1 uplist year to date. So maybe that's 7.5% of the deals done. My uplist was of significant size, $25 million. The 4 IPOs, while they've performed fairly well, they were all sub, let's call it $10 million.
Right. And that's where the market seems to be settled. It's extraordinarily difficult in these times to raise $15+ million, although 7 companies have done it this year. Let's talk a little bit, Michael, about the new rules here, with NASDAQ. And we'll just focus on NASDAQ for a second because they've been in the news a lot. So as you know, if a company has net income, they can generally raise, $5 million or more, continue to use their selling shareholders, put the book together to get to a $15 million public float. However, for companies that don't have that income or are still in growth stage, biotechs, anything that doesn't have that income, they are now forced to raise $15 million where their entire public float comes from the primary capital raise. And that's put an extraordinary amount of stress on the marketplace and the banking community because, as we just talked about, there's only been, I think, 6 or 7 deals in this year greater than $15 million. So what does a company do who's a domestic company, doesn't have that income, wants to list on NASDAQ or the New York Stock Exchange? How do they get a deal done? Do they stay on the OTC? Do they stay private? What do you recommend they do?
So let's go back a half a step. So the new rules come out of the evidence, your underlying data from the last 24 months. So as more of the IPO candidates became foreign private issuers and more of the money came from places like China, there were, in NASDAQ's view, some abuses in the marketplace where one or a small number of purchasers would buy the whole float in a nanocap IPO, which gave the ability for the stock to perform dramatically on the upside and typically dramatically on the upside and dramatically down on the downside. So what they did in an effort to cure these abuses, and because of prodding from the SEC, NASDAQ's regulator, they've come up with these new rules, both what we've suffered through the last year and a half in terms of them reviewing the potential purchasers of the offering, as well as come up with these new standards.
You know,
Over the short term, go on, Joseph.
I was gonna say I totally understand that point. I personally think these new rules are not going to do anything for the volatility in the marketplace. It defies logic to me that whether you raise $5 million or $15 million, that is going to be the difference maker in the marketplace. That seems absolutely crazy to me when all of these companies who are emerging growth by design, entrepreneurial by nature, founder driven, obsessed with execution and growth and forward momentum, that they're not going to have to raise more capital. And I guess the theory is that if you raise $15 million, maybe the stock will be less volatile, be less ability to be manipulated. I don't understand, because if you have a net income company that only has to raise 5 million and can plug in their selling shareholders, they're going to be subject to the same volatility. But, NASDAQ says they have data, they make the rules, we just follow them. But I'm not sure this is going to have a big impact. And that's just my personal view on this marketplace.
I think what they did is they just did what was easiest in terms of rule shifting, right? It had always been $15 million. You could just use selling shareholders, which means anybody who, so one of NASDAQ's rules is the market value of the public float needed to be $15 million. That was always. But you were able to register an existing investor's shares, someone who invested in the company 5 years ago, and that would count towards the $15 million market value public float. So what they did was, for ease of rule, I think, is just eliminate that ability. So they didn't have to start playing with whether 15 was the right number or 25 or what have you. You just cut those off.
Just made it harder for entrepreneurs and founders and emerging growth companies to really get public. Let me say something about this, though. And by the way, I don't think every company should go public. I think there's a place for everybody. Some companies should stay private. Some companies should stay on the OTC. And some companies should obviously try to list on NASDAQ and the New York Stock Exchange. But I will tell you, and I say this a lot, you ever try to get between a founder and money? That's not a great place to be. And if a founder is dead set on going to the NASDAQ and New York Stock Exchange, and they don't want to stay on the OTC, and they don't want to stay private, it is not our place or your place or anybody's place to talk them out of that decision, because they're going to get the deal done. They're not going to stop because they want my opinion, your opinion. Our opinions don't count. They are focused and obsessed on execution and growth. And that's where this undercurrent is. That's where the push comes from. So let's talk real quick, Michael, about uplistings, because that has been a challenged market over the last few years, mainly because NASDAQ had prevented doing a simultaneous reverse split and a listing a few years ago. That market has come back. Now there's some new rules here where if you can trade 2,000 shares a day, which isn't a terribly hard requirement, you may be able to raise less money or no money or sort of do it organically. So I don't know if you have any thoughts on the uplist market, but let's talk about that for 1 second, and then let's get to some last minute current data in the few seconds we have left.
Sure. So I find the uplist market extremely difficult, and I liken it to a house. It is much easier to get an architect and to build a house from scratch when you're starting with a blank piece of paper. But an uplist is like a rebuild. You have a existing capital structure, existing shareholders, existing valuations to some extent, and I generally shy away from them because while IPOs are impossible, I find uplist generally extremely difficult. I
They've
do
been
think,
difficult over the years, and but
yeah,
that market is coming back a bit. Let's talk real quick.
agreed.
Let's talk real quick. This is some current year-to-date 2025 data. As you can see, 61 deals, Michael, in the IPO world, microcap. $8 million still the median offer and very much tracks 2024, which tracks 2023. Uplist have been, eight of them this year, which is a little bit better than I think prior years. A healthy amount of money raised. Obviously, SPACs are an animal on their own. But I will tell you, and this is what I want your thoughts on, because of the new requirements on NASDAQ, it seems the microcap world is veering towards or heading towards direct listings. What are your thoughts from a banking perspective on a direct listing? And is that a more viable option for those companies that have selling shareholders, have a large legacy shareholder base, and now can't use them under the IPO rules? So they're transitioning to take advantage of them under the direct listing rules. What are your thoughts?
So they definitely need to do something. And to me, listing OTC is not the answer. If you want to go to April 11th, when the rule changed, I had 5 IPOs near term calendar. I cut 3 loose under the theory that I'm not likely to be able to raise $15 million for those companies. Doesn't that
I think a lot of bankers pare down their pipeline. But I want to point out one other thing, and you mentioned nanonuclear, which to me was the microcap deal of the year for 2024. What a phenomenal success story driven by you and your team at Benchmark Capital. But I will tell you, if those new rules, these new rules from NASDAQ were in effect in 2024, that nanonuclear deal would have never gotten done because they didn't have that income. We only raised $11 million in the IPO. And yet, because of the spirit of entrepreneurialism and emerging growth and founder execution, they were able to get that deal done because of a banker like you and then go on to raise $100 million, become a billion-dollar market cap, and off to the races. That's part of the reason why I don't think throwing the baby out with the bathwater is good for the emerging growth space and why these new rules are only going to hamper capitalism and hurt founders and hurt entrepreneurs and maybe protect the markets a little bit, but the jury is still out. But that nanonuclear deal would have never gotten done. And that to me was the deal of the year.
Thanks, Joe. Love working with you on the nano and all the other transactions. And we all need to focus on direct listings a little more because the traditional IPO market at the moment isn't there. And some of it, we'll save it to another time. Time's up. We can absolutely do another topic. I'd love to talk about, to some extent, why IPOs aren't there. The fundamental investor is one of it, but private company valuations is another interesting topic, just that people raise money privately at such lofty valuations that you can't support them in the public markets, and issuers don't want to do down rounds. But we'll leave that for another seminar.
Well said, Ben. I think we're
All
back
right.
to you.
Thanks. Yeah, no, thanks, gentlemen. Thanks. I want to thank Joe and Mike for their time here. Looking forward to having them at our future events. To everyone listening, thank you for being here and have a great rest of the conference. Thanks, everyone.